What's going on, guys? It's Justin from Push and Profit, and in this video we're gonna go over credit spreads and then go over some examples of credit spreads as well. So definitely make sure to watch till the end of the video because I'm gonna really break this down. Now, once individuals become exposed to the option market and garner a basic understanding of options such as buying and selling options and also understanding pricing dimensions, it's time to move on to more of an intermediate level of trading. Now, the next level is going to be vertical credit spreads, which comes in two shapes: bull put spreads and then bear call spreads, which we'll touch on more later on. Now, vertical credit spreads offer traders a nice limited risk strategy, and personally it's one of my favorite types of trades. And this is because with credit spreads you essentially profit from the decay of time value, and also credit spreads don't require any movement of the underlying stock to produce a profit, meaning if the stock moves sideways or doesn't move at all, you still make a profit. Now, if you're familiar with the basic single leg options like buying a call or buying a put, then you're probably familiar with something called theta. Now, I don't want to get too deep into theta, but basically theta is part of the option Greeks that influence an options contract as the contract gets closer to the expiration date. So when you buy a single leg options like a call or a put, the longer it takes for the underlying stock to reach the option strike price, the more the contract's going to lose value. And the option contract, once it gets closer to expiration, your call or put is going to be losing value. And then once expiration has come, if the underlying stock has not reached that strike price, then the contract becomes worthless. So however much capital you put in that trade becomes zero. You lose it all. You lost all your money. But that's what we're going to talk about. So with single leg options, you're constantly fighting with theta, which is time decay. Now, as I said earlier, with credit spreads, you profit off time decay. So theta's on your side. Now, I'm going to be explaining credit spreads and how they work. And it might sound confusing, but credit spreads are generally low risk option strategies. And if you really want to take advantage of this trading tactic, then make sure to walk through this video to the end, because I'm going to be showing you guys some real life examples. And I think once you guys see the examples at the end, you'll have a better understanding. But of course, you got to stick through the fundamentals. Now, with credit spreads, you're simultaneously buying and selling options with two different strike prices. And simultaneously buying and selling options with two different strike prices establishes a spread position. And when the option is sold more expensive than the option bought, a net credit is resulted. And this is known as a credit spread. And it's called a credit spread because in the nature, the position is built using options moving vertically along the options chain, which is what you'll visually see later. Now, vertical credit spreads could either be call spreads, right? Bear call spreads, or put or bull put spreads, right? Now, while this may sound confusing, again, once you visually see it, you're gonna be able to better understand it. So with that being said, we're gonna go ahead and hop into my computer so I could display exactly what I'm talking about, and hopefully you guys get a better understanding of credit spreads. Maybe you guys might want to implement this into your trading strategy. But with that being said, if you guys learned anything in this video, make sure to hit that like button. It really does help out with the YouTube algorithm. So let's go ahead and get started. Alrighty, so now we are officially in my laptop. Now, the platform that you see before you is the TD Ameritrade Thinkorswim platform. This is one of the brokerages that I use to make my trades. Now, I just mention this because often in a lot of my videos, a lot of people ask what I am using to trade with software. So it's the TD Ameritrade Thinkorswim platform. Now, again, when it comes to trading, you could use any platform that you want to use, right? So if you're someone that wants to trade on Robinhood, then by all means trade on Robinhood. If you want to trade on any other brokerage like Tastyworks or etc., it's all up to you. Now, just because I use this platform doesn't mean you have to use it. This is just a platform I feel comfortable with. But now, with that being said, let's go ahead and take a look at a few things. Now, if you guys see right here, you guys can see this profit of $26. It's a very small profit for the day. This is actually on my small account challenge that I'm doing. I have a series on YouTube where I am turning $100 into $1,000, and I'm using it on this small account. And then this is going a little off tangent, but it's kind of still relevant because all the trades that I'm using on the small account are with credit spreads, right? So I'm literally turning an account from $100 to $1,000 with credit spreads. And those are pretty much the only trades that I'm trading. So if you want to check out that series, I'll probably just link that up somewhere. But again, let's go ahead and take a look at a few more things that are back on tangent. So this is Coca-Cola stock. Right now we're gonna go to the options chain. Right now, the options chain, this is basically how it's broken down. You could choose the time period that you want to look at. So let's go ahead and look into a further time period. Let's look at the 19th of February 2021. Right now, we're gonna see that over here on the top left hand quadrant, that is the in the money for calls, and then this is in the money for puts, right? And then this is out of the money for calls and out of the money for puts, right? So typically when you do single leg options, you're just buying a call, and then, you know, hopefully the underlying stock hits that strike price, or you're buying a put, and then hopefully the underlying stock goes down and falls into that strike price, so you can make a profit. Now that's not really the case with with vertical credit spreads, right? So with vertical credit spreads, you're selling and then buying a contract simultaneously. So for example, let's go ahead and take a look at Coca-Cola stock, and let's go ahead and take a look from a 4-hour view, right? And I know there's a lot going on, so I'm just zooming in a little. So currently Coca-Cola stock is at $49.35, right? Now I don't want to break in too much into technical analysis because I have a bunch of videos explaining that, but let's just kind of go a little deep into technical analysis for a few seconds. We see that Coca-Cola stock is, you know, bouncing off this linear regression channel. We see that it just recently went above the blue exponential moving average, right? So we see that, you know, it's very bullish, right? We have a very bullish sentiment, at least in my opinion, that Coca-Cola is going to go up. So what I would do, right, or actually what I'm doing in one of my trades, but what I would show you guys is if we go to the options trade, if you're very bullish, right, you're going to sell puts. Now, I know that may sound confusing because technically with single leg options, if you're bearish, you're going to buy puts. And if you're bullish, you're going to buy calls, right? But however, when you're selling, right, and you're doing credit spreads, it's going to be reversed. So if you're bullish, you're going to sell puts and then you're going to buy a call, with the put being more expensive, you know, than the call. So let's go ahead and go over here. And let's say I'm like, okay, I think Coca-Cola is going to keep going up. I don't think Coca-Cola, right, is going to hit this area of $46.50. So essentially you click to sell it. So here I'm selling 10 contracts for the expiration date of 19th of February 2021. And I'm selling a strike price, you know, of $46.50. I'm selling this put. I don't think Coca-Cola is going to touch this. I think it's going to continue going up. Simultaneously, I'm buying 10 contracts of Coca-Cola for the same, you know, expiration date, but for a slightly lower, right, strike price. So we're selling the $46.50, but we're buying the $46. So this gives us a, you know, net credit of 8 cents. But of course, you know, with options, there's a multiplier of 100. So we'll go ahead and kind of explain this. So 8 cents, then we're doing 10 contracts. So over here, you're going to see that, you know, we're risking $420 for this trade, and our max profit is $80. Now, the $80 again is really just broken down because, oops, and I just went out by accident. You know, it's 8 cents, so you times that by 100 for options, and then we're doing, you know, 10 contracts, right? So there you go. So that kind of explains that. And so again, you know, we're risking $420 to make 80. Now, typically you would think, hey, you know, that's not really a good risk to reward ratio, and it's not. But the thing is, you have a very likely chance that it is going to go in your favor because your goal, right, is literally just for Coca-Cola stock just to not touch $46.42. So when you're trading it, we're doing these credit spreads, Coca-Cola could go up as much as it wants. You're still gonna make the same $80. Or Coca-Cola stock can move sideways and not even go up. It could literally just move sideways. But as long as it doesn't touch that $46.50, which is somewhere down here, right, in this area, as long as it doesn't touch this area, you're literally going to make a profit. So Coca-Cola stock can go up, then maybe go down, then go up, go down, go up, go down. And if it just stays in this range without touching the $46, what happens is data will kill off the, you know, options, and then you're making a profit. So to kind of elaborate a little further, you're selling this put, and basically someone is buying this put that you sold, and they're trying to make a profit for $46.50 off the put that you sold. But they're going to be losing money because the put is going to be expiring, right? It's going to have the expiration date. And as it gets closer to the expiration date, if it doesn't hit the strike price, you make a profit. So you're kind of essentially selling them a trade that you don't think is going to happen. They're buying it and you're making a profit off of them, buying this spread for you, right? Now, there you go. That's how you sell puts. But the reason why we're buying calls is because it limits our risk, right? So essentially you could just sell the put yourself and you would make good money by selling the put, but we buy the call, we buy the put version of it. And the reason we're buying the put version is because we just want to risk it that just in case for some reason Coca-Cola stock starts going down and it goes below $46.50, that put that you actually bought is gonna offset the put that you sold, so that the max you could lose is and I think I clicked the wrong one, so that the max you can lose is only $420, right? So hopefully that kind of explains it a little bit better. I'm going to show you guys another example, right? Now, again, remember when I mentioned vertical credit spreads? The reason it's called vertical, as I mentioned, is because you're literally just going vertically, buying and selling either calls or puts on the option chain, right? You see, it's like a vertical thing. We're buying, and we're selling, and then we're buying. Now, if you're going to be selling calls, you're going to be bearish, right? So when you're selling calls, you're anticipating the stock to go down, and you're expecting that's not going to go further up. So that'd be a bull call spread. That's going to be a and sometimes I get mixed up with the name, so sometimes it's very confusing to think about it because it's honestly opposite. So if we're selling puts, that's going to be a bull put spread, and for selling calls, that's going to be a bear call spread, right? Again, I know it's very confusing, but let's go ahead and take a look at Coca-Cola stock still, since we're already on here. So if we're over here and for some reason, we're like, okay, Coca-Cola stock is bound to fall down, it's getting close to the RSI. I don't know, for some reason you just believe Coca-Cola stock is going to fall down, right? You're very bearish on it and you just don't think it's going to go up. What you can do is sell some calls. So we see this area of $50, you're like, I don't think it's going to pass that. So you could say, okay, well, this is what I'm going to do. I'm going to sell the $52.50, and we got to switch this to sell. I'm going to sell the $52 call, but I'm going to buy the $52.50 call. So this gives us, a price of 9 cents per contract. But again, with options, it's multiplied by 100. So that's $9 times, of course, 10 contracts. You're gonna max profit $90, but you're risking $410. Now, again, you're risking more than you can make, which is bad. But the likelihood of the trade going in your favor is very likely, and the reason is because typically when you're trading, right, single leg options or even just day trading stocks, you need to buy and then sell, and so you need to have the trade going in a specific direction. So if you're not shorting, if you're just doing regular trading, trying to get an upward trend, you would buy low and sell high, right? And that's how you make a profit. You need the stock to go high. And then of course, if you're shorting, you need to sell high and buy low, right? And you'd make a profit with the stock going down. Now, again, those are both directional moves, right? But the thing is, when you're doing credit spreads, you don't need it to go in your direction. You just either need it to go in your direction or go sideways. So essentially, there's a higher chance that it could go in your favor. Just because you have two directions, you still win. So going back to this example of selling the 52s, and we got to hit sell, selling the 52s and buying the 5250s, we're saying, Coca-Cola stock is not going to hit $52, right? We're very bearish on it. We're like, it is not going to go higher than $52. It's going to go low. So as long as, Coca-Cola stock either moves sideways or it goes down, you're making a profit off of Coca-Cola stock. So hopefully with these examples I'm providing, you guys kind of get a better explanation of how these actually work. Now again, going to the options chain again, if you're selling the put, you're bullish, which is opposite, and if you're selling the call, you're bearish. Again, that's really the most important part to remember. It's just opposite that you would naturally think of. because we would normally associate calls with being bullish and puts with being bearish, but again, we're selling it, so it's going to be on the opposite end. And really, like I said, you're profiting off of the, contract expiring, because the way I like to think of it is you're selling someone something that you hope doesn't happen, and they're losing money while you're making money off of them losing, because their contract is expiring, worthless, and you sold that to them. But if you guys have any questions, make sure to leave them down in the comment section below. Again, my name is Justin from Push and Profit. Make sure to like this video. Also subscribe to the channel if you haven't done so already. And also check out the links in the description below, because one of the links is going to be a link to my free Facebook group, the Push and Profit Facebook group. And another link is going to be a link to sign up with Webull, which is another powerful brokerage that I use. And if you sign up with Webull, you'll be eligible to receive one free stock valued up to $1,600. And when I signed up for Webull, I got a free share of Google, and at the time Google was worth $1,200. Now Google is worth obviously $1,900 now, but when I got that free stock, it's worth $1,200. So again, you never know what free stock you're gonna get. It's guaranteed as long as you open up that account with that link, so definitely check that out. And again, my name is Justin from Push and Profit. Hope you're having a beautiful day now, and take care.